What's up, Colorado Springs? Chris Lopez here with the full studio. We have a client of Envision Advisors in the studio to come talk some long-term strategy. He comes from San Francisco, background in some multifamily investing, lots of experience in stocks and bonds. So we're going to talk some fun, big picture investing strategies. But he also just closed a few months ago on his first house hack in the Springs. We'll talk about the move, the numbers, and get into some longer-term strategy. My two co-hosts are Ben Einspar. Ben, what's up?
What's going on, Chris?
And then Jenny Bayless. How are you, Jenny?
I'm doing awesome. How about you, Chris?
Doing really good. So you helped our guest and client buy his first house hack, I think 5 or 6 months ago, was it? Set it up and introduce him.
Yeah, so we are here with Michael today in studio, and he worked with Leah to close on his very first house hack. And spoiler alert, he closed on a fourplex today with her as well. So we'll get into that. We'll kind of, chronologically get there. But Michael, thanks so much for coming in, and we're excited to kind of learn your whole story, and how you got here. So I think the best question to kick it off is, why San Francisco to Colorado Springs?
Right. So I was born in SF. I was there for 30 years, and investing in real estate there is really tricky because the amount of capital required. And there was options. I remember in the beginning I was looking at Sacramento. It's a lot cheaper. You can drive up there, but ultimately you have a lot of property taxes going on. Just there's like taxes on taxes over there. And at a certain point, you don't really want all that regulation, right? I think it's like over-regulated in many ways. So at that point, it was like, okay, where am I going to be moving to invest? And so I was thinking Arizona. I have family over there. However, when looking at real estate, I'm really looking for appreciation over cash flow. And I know that Arizona, the cash flow is higher than in Colorado Springs, right? So at that point, I was looking at Colorado, and I actually found on the Bigger Pockets website that someone was saying that it appreciates more than Arizona. So I was like, let me look into this. The next thing that I found was that climate change, as far as there was a list I saw, there was 10 states with the least effects from climate change, and Colorado was actually one of them. It was like number 8 or something like that. And so I was like, okay, that's important because I don't want to live in a desert for 50 years and have all these massive problems. I was really looking at a 10-year time frame in Arizona before there's some serious issues with infrastructure and
That's interesting. So a lot of Colorado as a whole was on the list, or it was just Colorado Springs?
It was Colorado Springs was actually listed as the location, but Colorado as a whole will do better. Surprisingly, the place that was listed the most times was actually Virginia, which, I mean, I've never been there, but it was on that list quite a lot. So it's,
Interesting.
Well, Jenny and I are both from Virginia. It's very humid, very wet, and no extreme weather. It's pretty humid and boring.
Yep.
Sure.
Was there a point during this search that you were considering the Denver metro area? Or was it all strictly Springs?
Definitely not Denver. No, I know everyone here loves investing in Denver. It's just really, I'm looking to be in the next market. Denver to me is already the market. So as somebody who's leaving a very high expensive cost of living, I actually want to get more leverage for my dollars. And so that's Colorado Springs. Yeah.
All right, so this will be fun to talk bigger picture stuff because obviously you put a lot of thought into it and not just, I want to buy a place today, but you're looking at, a multi-decade approach, which is the best way to approach, a wealth building strategy. Mm-hmm. So getting down to Springs, lower price point, very attractive market. It's in a lot of the top lists for growing places, all that stuff. So what type of house hack did you want to do, and why start with a house hack versus straight investing?
Right. Well, firstly, it's my background as well. I do software engineering, so I'm really into efficiency for things. I really look at like ratios of time and money and stuff like that. So as far as house hacking, it makes sense to me to live in a property and rent out rooms because number one, I'm fairly I respond instead of reacting which if you're big on reacting is probably not a good idea for living with your tenants type of thing. So overall, I feel pretty good with that, and it just seemed really inefficient to have all this empty space. You know, I'm really a minimalist. I actually want less things in my life because they take time to maintain them and care for them. So it made sense on that in that aspect. And then in San Francisco, you know, you're living with roommates. I mean, good luck. It just doesn't make sense not to in a way. So it seemed familiar. And originally I was looking for kind of like a duplex situation where there's 2 doors, like one mailbox, but 2 doors. Right. And I got outbid. It was really competitive for that because they AirBnB it, which is definitely an attractive thing to do in the Springs. So I ended up with the 1 door option, but there's the basement and then there's the upper level. So you have 3 units upstairs and then you have me in the basement, and the layout of the house lends very well to actual privacy, which was good.
Yeah.
So, oh, go ahead.
I was just going to say, I think the neighborhood that you're in has a lot of that style, where it's like the garage and the basement kind of are pocketed from the front door. So I've seen a lot of opportunities for it in that neighborhood, and the fact that it's a newer build is kind of cherry on top.
So are these ranch style homes or 2-story homes?
They're 2-story.
Okay, 2 stories with a basement on it. Okay, so it sounds like 3 bedrooms upstairs and then a bedroom downstairs in the basement?
Yeah, ultimately it was a 4-bedroom, 4-bath. I wanted more baths because I didn't want people sharing too many bathrooms type of thing. So upstairs there's 2 units and they're about 110 square feet. So they're like fairly small. I'm charging $650 for each of those. Then there's a master bedroom that has its own bathroom. That one is larger. That one is $800 a month. And then I charge $50 for half of the garage, and then I have my motorcycle in the other half.
Okay.
Yeah.
So it sounds like, the master suite has the private ensuite, full bath, and then the 2 other bedrooms upstairs, do they share like a full bath up there?
Yeah, they do share.
Okay, then half bath on the main floor kitchen area?
Right. Yeah. There's a half bath right there. There's the garage. You come in, kitchen, and then in the garage, you swing a left, and then there's the door for the basement. So it's actually opposite long ways as well as height ways. So the distance
it's good
from
privacy.
It really is.
Yeah.
It worked really well.
Yeah.
I was very surprised. I thought that I would just be hanging out all the time with the tenants, which isn't necessarily a bad thing, but I think it's good to have the ability to have the privacy.
Oh, yeah.
Yeah.
Okay, so then basement, good privacy, bedroom, full bath down there, and some living space?
Yeah, so it's pretty spacious. I would rent the basement out for $1,200. So you have the living room area. I have a space for an office in there, so it's kind of this open concept. Then you have a full bath with a double vanity. And then I have my bedroom. I've gone and I got a mini fridge down there, which is it's like larger than a hotel fridge. There's a mini fridge over here I was looking at.
So bigger than this one, right?
Yeah, bigger than this one. And I have a double burner hot plate.
Yeah.
And then I'm just rocking like that. And with the double vanity, you have one that you use like for bathroom things and then one for kitchen things.
Yeah. Oh, that's an interesting way to set up. Okay. That actually makes it really, especially for because it's kind of a bachelor pad for you, right?
Yeah.
So that's a great way to use a double vanity. I like that a lot. Did you put a garbage disposal in there yet?
Yeah, that would be the next step, right? I do want to get a plumber down there eventually if I ever move out to really get that set up as like a full kind of suite.
Like to pull that and make a wet bar? Like to pull out the water and make a little wet bar where the hot plate and that's a really common thing we see. A lot of times people will buy houses like that, or if depending on where the plumbing is, it can be like, hey, for a couple $1,000, it can be very easy thing to tie into.
Yeah. When you look at it, definitely maybe while you're living there, it doesn't make much sense, but after you move out, when you look at what rents you can get, it's definitely a great return on your money.
Totally.
Obviously, Ben's brain here when it's time for that stuff.
Oh yeah.
So give us a high level numbers on here. I know you bought this a few months ago. What was kind of like the general price point, and then the how much you're living for or getting paid to live there for?
Gotcha. Yeah. So I have the numbers right quick on my phone here. And I got it open for this here. So originally it was listed at $450. And I went 10K over just to close on it. It had been on the market for a little bit of time. I would say almost a week, which at that time was really a long time.
Yes.
I love how that was.
Yeah.
Oh, that was it's been on the market for a while, like almost a week.
An eternity. Yeah.
The undertone there.
Oh yeah. When the ones that I was looking at that were 2-door style were on the market for like 3 days, in max.
A few hours, right?
Yeah. You're like
with,
trying
with
to
10
get it
offers piling up in front of them.
in. Yeah, 100%. So I did 5% down, 3.25%. So I am loving it.
Yes.
That is fantastic to me. 30-year term. And let's see here. So it's $2,100 for the gross rent coming in. I'm budgeting 5% on maintenance because it was built in 2000, I'm not big on old property because when I was younger, I used to do building maintenance and apartment like remodels. So I understand how old buildings just require time. And I don't really want to.
And money.
Yeah. Yeah. Exactly. It's like time is really like money squared in a way. But yeah. So then as far as utility. Okay, so let's start with real estate taxes. $774. Annual property insurance, $1,711. Water and sewer is averaging about $75 a month. Trash, I was surprised, is $99. However, it's because I do pay for a recycling bin in addition to a trash bin. I could just buy like a bigger trash bin.
Is that $99 not a month, right?
It's a month, man.
Really?
We need to talk after that. That's pretty high.
That's from SoCo.
Yeah.
Yeah.
Is it really?
Yeah.
Interesting.
Yeah, I don't know if they have like a new rate or whatnot.
Yeah.
But
That seems
worth a call.
Yeah.
'cause I know for my primary residence up here in Highlands Ranch in Denver, I pay like that a quarter.
Yeah.
Oh.
And then I have a fourplex in Westminster, and I pay $90 a month for a dumpster.
Gotcha.
That just seems crazy.
Yeah, it might have actually been 2 months because I remember there was like a credit card billing thing.
Yeah.
But you're right. That's why I was surprised at that. The thing is I have so much going on that like
it's not worth it.
like
now it's
for
over
$40
$50 a month,
yeah.
I have like bigger fish going. So
We know how that goes.
Yeah.
electric averages about 80 a month, gas is 60, and then internet is 40.
Okay.
I just got solar yesterday, and it's pretty good. I got 15 panels, 6 kilowatt system, 1.98% APR, no money up front. That's from Blue Raven Solar. So yeah, very happy with that. I think that's going to be good. The only thing that I'm kind of concerned about is when I need to go re-roof, like how is that going to work? How much labor is taking those panels off? Aside from that, I think it's like a home run just on many metrics. Like you're not paying anything up front. They have a rebate program for 5 years where they actually comp you. So it's going to be lower no matter what. And then with inflation and then those terms, it's just,
Yeah, I have solar in my house. I know exactly what you mean, and
nice.
yeah, I think it can make a lot of sense, and so it's something people should look into for numbers. So while you're living there, what do you approximately like paying for you to live there?
Right, I would say it's probably anywhere from like $500 to $600, I think, a month, depending on kind of the utility spend and if there's like a little bit of maintenance or so.
Yeah.
For me, I don't mind spending a little bit more for the quality because I just live there myself and it's, I enjoy that. So,
And you work from home too, right?
Yeah.
Yeah. So if you're spending a bunch of time on there, that difference of paying $500 a month or $800 a month for a bunch of privacy, splurge a little bit.
Yeah. Especially since when you move out, you just mentioned $1,200. So,
Oh, yeah.
So that's a really good, turnover rate when you move out. So.
So let me ask you this, because I know you came from San Francisco, and we know we help a lot of people, relocate. You're not the first person to move to Colorado and buy a house hack. what tips would you give someone for like relocating and kind of that, semi, long distance learning, looking at the market, putting an offer process?
That's a good question. So it's really going to depend on who the person is. Really, I think their personality is going to play into their values, right? For me, I'm a grinder. I came out here to grind. So, I'm not looking for like nightlife. I'm not looking for, these things that would be in a city that you would normally get, right? So it's quite a change of pace compared to where I was living. But for all my needs, it's a good fit.
Yeah.
I would say for someone coming out here, I think you really need to look at the long term given the situation right now, right? So it's going to be a tighter market as time goes on. You have the federal interest rate projections. I don't think it's going to get easier to buy a house. Inflation is going to be strong for some time. I don't think they're going to wrangle that for a while. Where else are you going to put your money, really? If you have a sizable amount. Now, there are I bonds at like about 9% right now, which is pretty good.
Yeah, we can buy $10,000 worth a year.
Well, okay, yeah. I mean, there's a fair point.
There's a limit. That's a problem.
Yeah. There's a fair point to different limits on bonds that that are offered.
I'm a big fan of I bonds. Like I love them.
Yeah.
Can't buy that much.
Yeah. So that's what I mean is that real estate is really one of the few major plays that you can do. The stock market's going to be trashed, in my opinion, 6 to 18 months. I think it's going to be a lot longer than people think.
Well, let's talk about this because I know we started chatting a little bit. Then we say, hey, let's actually hold this conversation from the podcast because you have a strong background in equities. You talked about you were exposed to it from an early age. Obviously influenced you. You do a lot of active trades now.
Yeah.
And I know you had some questions on the real estate market, which I think would be great because other people have that question. And I would love to kind of just do some high level like strategy debate as well because we talk about the same thing, like, we're obviously big fans of real estate, but we're even bigger fans of owning like, multiple asset classes.
Right.
And there's pros and cons to everything. It's always fun to like kind of like talk shop and debate, especially since you're very experienced on that side, we're very experienced on this side.
Yeah.
Be a little fun conversation. So with all that, not sure when to start off. If I know you can start off with macro stuff, or if you had some specific questions, we can jump into it that way.
Yeah, sure. I know that this probably has been talked about a bit, but it's really that forecasting. Usually the approach is to not time the market, but if you can time it pretty close, it's a big deal. So I'm wondering, as far as I have my timeline for the overall stock market, and with this fourplex that Jenny was talking about, I want to actually pull the money out with a cash out refi. And then I'm thinking of putting it in some sort of fixed income temporarily and then rolling it in the stock market at what I would think is roughly the bottom, and then using synthetic longs to get even larger leverage, like buying leap options on stocks. And then from there, you take that money, which is now long-term capital gains because it's over a year, and then you roll that into real estate. That's basically my plan. So I'm thinking that the stock market and the real estate market are both going to have their lows, but I don't think they're going to be at the same time. So it's really the timing of the actual macroeconomics for the industries. So let's okay. So stock market lows. What, later this year? Next year? I'm thinking next year.
Next year?
Yeah, the interest rate rising is just going to be crushing because there was no other option but to invest in equities because bonds paid nothing. So now you're going to have all these high growth stocks that don't make any money. They're just like, they're negative on cash flows, and those are the first ones that get crushed, right? So you have your like tech stocks and your growth stocks, then you have your like value stocks, which should hang on pretty well, but they're still going to go down. Really, commodities may be going up. So you're looking at like Exxon's probably going up, Freeport McMoran, you're looking at copper mining, stuff like that.
Okay.
Yeah.
Now, how do you time that with you said the real estate lows? I mean, I don't see any price reductions or price drops in the near future. With an asterisk, I think there will be some headlines or some we will see some price declines, but that's actually more from a like statistical way to derive it. Because one of the things that started happening during the pandemic is Denver Metro, and I don't know for Springs, but Denver Metro started selling a lot more expensive homes, like $1 million plus homes. So, that weighted the average up. Okay. $1 million, $2 million, $3 million plus homes. We started selling a lot more of those, which is why we started seeing some very, very big overall like price increases. And we're starting to see some softness in that market. So I think we might see some headlines where prices decline. And it kind of depends on, the mix of what we're selling. As we go from selling, 100 expensive properties a month now to 50 expensive properties a month, that obviously is going to change the weighted average on there. So I think we'll see some headlines on there. But I still think a lot of like the affordable below median income prices, I don't see a true price drop coming onto there. So there's my long answer on there, but I'm curious on how you are going to try to time the real estate market and when you think that might be.
Yeah, real estate market.
I'm fascinated by this.
Yeah, well, it's tricky because of the interest rates. So what I was originally considering was you have this fourplex, which was purchased with cash. So I was thinking about doing almost a waterfall investment strategy where you roll it into smaller units. Maybe you get instead of buying another fourplex, which might be a little bit tricky, probably could do it, engineering job, you pull out some money, like maybe you work that out. Or you just get 2 duplexes that are fully paid off type of thing. Ultimately, though, I want to get the money out of the real estate so that I can reinvest it at a higher rate and do some sort of like rate arbitrage. As far as timing, yeah, it's a little tricky because I have experience in say maintaining and renting, serving leases. I've served 30-day notices. When I was young, I have experience in that. But as far as the acquisitions, purchasing and selling real estate, I don't really have that much experience in that. I'm, here doing it, of course. So yeah, the timing is tricky. I'm not sure, right? So we have inflation that is going to be slowly going down. So now you're going to have lower appreciation relative to what it was. You're going to have demand that's going to be going down because of tightening on the rates. And then a lot of it to me comes down to how much building can these builders build? If they're cranking out homes, that could be a serious problem. It's almost the ratio of the supply more so than the demand.
Well, we're not going to get a supply influx anytime soon from the builders. The last 10 years, they have been like nationally, they're like 5-6 million units behind, all but down the front range. Ever since the 2008 crash, we have a huge, like a deficit every single year. So we have like year after year of deficits. Okay. And with the way the last year supply chains have been, labor has been, I don't hear builders talking nicely about the process of getting things approved.
Oh, sure.
They're building stuff, but it's not going to be a huge wave. And a lot of times they're actually building, more like upper end luxury products because that's where the margin is. Very hard to make margin on the lower end stuff.
Gotcha.
Something we talked about, pulling out, because you closed on the fourplex today. Congrats, by the way.
Thank you.
And I agree with you. Like leaving cash, 100% paid off property, horrible use of equity on there.
It's like dead money.
Especially, you're young. Yes, you leverage up. Hey, when you're 90, different story. Sure. But right now we're in growth acquisition mode and leverage the way to go. And I know you're looking at different loan options and kind of structuring stuff on your part because you're self-employed and some K1 activity, it sounds like. You could also look at this, popped in my mind, we were talk to some like local banks, like the First Banks, the Westeras, the Vectras, not the 30-year conventional mortgage brokers. A lot of times they have a lot more flexibility for doing some type of like HELOC on a property, and they can do it off of your global debt to income ratio, and it's less dependent on your W-2. It'd be more HELOC product, but that could be worth some phone calls to bankers. I can give you a few after we're done here. I know Jenny's got connection as well, but that would be an option to think about too. It'd be more of like a line of credit. Right. They might do a second on there, but I think I've seen line of credits more. But that might be an option to look at too, to just pull out some equity.
Yeah, the financing has been an interesting part to me because I'm so used to doing things very efficiently that when they don't go, I don't know if it's the engineering part, but there's like a process, just give me the information online, then I can make the decision. However, financing is so relationship based, which is fine. I'm fine with that. It's just, I didn't know that coming in. So I'm kind of like going against the grain a bit. And then my expectation is different, and I'm like, but it's cool. I'm curious with those, how much higher like ballpark is it than whatever the base like 30-year fixed rate is?
It depends a lot because they have, less banks do HELOCs and seconds on investment properties. A lot do it out there. When I looked at this last year, so this was before interest rates changed. I found a couple that go up to the 70% LTV or combined LTV. And back then they were, well, it's hard to say the 30-year fixed. Back then they were at like mid fours. Maybe high fours. So depending on the LTV in this, you're probably going to be, I'd say prime +2, prime +3, would be a completely kind of like, wild ass guess. But you'll be paying more, but it's worth looking into to see,
right?
Especially like with your situation, building some of those bank relationships can pay off tremendously as you start, repeating and rinsing. And they have a lot more flexibility in those local banks. And as you're saying, I kind of like, I started, I was like, oh yeah, you're coming from like equities tech background, which is like super efficient, efficient, data on demand.
Right.
Now towards real estate, you're like, holy crap, this is inefficient. Why can't you just tell me what this interest rate, or why can't you tell me this?
Yes.
Why do I have to wait 3 weeks?
Oh,
so yeah,
my gosh.
it just hit with me like what a difference in world it is. So get used to hurry up and waiting. But that is where in the inefficiencies, that's where we can find some way better spread than you can in the stock market because we don't have high frequency traders or content on demand. So the grind comes into relationships and really getting like micro trends.
Wow.
So yeah, relationship banking for you could be a big thing. I'd say I'd throw on your radar.
That was a really great way to put it because I was like looking for the positives. And the idea of, the market inefficiency and capitalizing on like the bid-ask spread in financing essentially is a really good point, I think.
Well, I'm glad Chris translated that for me because because I know you'd be like, well, why do I have to call them? Well, I don't know. It's just what you do.
Yeah.
So, okay, now I understand where it's coming from.
Yeah, I was expecting terms to just be on a website and say, oh, okay, well, that's going to be a match. And, I've heard people who go for financing and there's like a very vague response on why they get denied or whatnot. And I'm like, what does that even mean? It's like the quintessential, we're going in a different direction. Like, what are you telling me type of thing. So, that's cool.
Okay, yeah.
Do your personal financial statement once, go send off to 3 or 4 bankers at once and start the process. And a month later, you'll have terms.
Okay.
I'm doing a HELOC right now, my primary, and I'm talking with 3 and I've yet to get terms. I'm 3 weeks in, but that's the way it goes.
Wow. Wow. That's almost as bad as the software engineering interview process, but it's a little bit longer. Yeah.
I don't have experience with that. I read the Google stories though.
Yeah. Ooh.
Yeah. So, I'm curious, Jenny, Ben, I'm kind of like asking a bunch of questions here. What advice or input or?
Yeah. I can't speak to anything stock related. I'm very, very green on that. So, but I really like Michael's thought on, you call it the waterfall refinance. And it's something that I don't think that we think about too often because typically we buy and then it grows in equity and then you cash out refinance and then you buy something bigger and so on. But you're starting off with the larger valued asset and then you're taking, 75% of that, deploying it into another property, 75% of that, and so on and so forth. So I think that's a really interesting way of deploying leverage as well, that I don't think a lot of people use. I have not experienced that before. So
the other thing on the going back to the HELOC route that I think your mind would find interesting is a lot of HELOCs are interest only. So not only are you getting potentially a huge chunk of equity, it can be interest only payments for 3 years, 5 years, or 10 years until that HELOC matures. So if you really wanted to like maximize leverage and minimize paying it back, a HELOC might be a way to go. They have a lot more flexibility interest only.
Yeah, I'm very excited about that.
Yeah.
It's interest only is a key word there.
We usually get on that. I mean, you get interest only in some like bank loans, but that might be for like a year or two, and then it goes back up to there. But like I'll give you a few bankers to talk to.
Okay.
And I mean, Jenny's got a few down there she's worked with as well, so definitely worthwhile to pick their brains.
Okay.
Especially with your at, that could be like that's for, as a lot of times investors I've noticed as they grow their portfolio, a lot of times start with house hacking, a lot of 30-year fixed as they grow and their assets get more complex and they also want to kind of have more simplicity. A lot of times they'll move, they find their banking relationship, their one or two bankers they work with, and this becomes like a repeat and rinse cycle for them.
Totally. Yeah, that's a good deal. I was looking at 5-to-1 ARMs.
Yeah.
Because I really think that 5-year target, the other ways you would deploy your capital, if it's not in real estate, is going to just be fine. It's really, I guess, the prepayment penalty, things like that you have to look out for. But if I could get an interest only on one of those, that would be pretty sweet as well.
A lot of the residential ARMs don't have prepayments on them.
Okay.
I mean, definitely for like the commercial, like 5+, you'll see a lot of prepayments.
Sure.
Yeah.
I mean, First
Like First
Bank,
Bank
a couple other ones I think of. I
didn't
mean,
for
I
me.
haven't seen many
Good deal.
prepayments on there. So, I mean,
Okay.
definitely look at, but that's more in like the 5+ like real commercial properties you start seeing that. Residential, I don't see prepayments in ARMs.
Yeah.
I can't think of anything I've seen recently. Of course, I mean, things may change in the market.
read your loan disclosure.
So we kind of talked about timing the market. And Jen and I earlier recording a podcast, we're talking some strategies. One of my things, I'm gonna buy more rentals this year.
Nice.
And I'm always want the lowest interest rate, but I'm a leverage guy like you and hold on for 5 years, I'll be in a good spot. One of my what ifs, this may happen is, buy a property now, we're 6% or 7% later this year, whatever it is. And when a recession happens next couple months or years, which I have a high probability of, I think there's a chance we'll see interest rates dip to help funnel some stuff. And I've heard this like a lot more economists and other investors say. It's like, I can believe it. I can see it as a possibility. I'm not banking on it, but I'm like, if I buy something I'm happy with it and interest rates drop, I'll refinance. But if they don't, I'll hold on for that 5 or 7 year maturity and kind of stick with the game plan. But if I can refi and drop 1.5 points, I'll spend a few $1,000s on that. So since you kind of learned the market timing, what are your thoughts on interest rates?
So one of the reasons that I decided to leave and get in a property and find a job so I could qualify for financing was the Federal Reserve schedule. So they came out, they come out with their paper, right? And it's funny because you'll watch the news, but I think that's a bad way to get your insight unless you're really strapped for time. So I get the report, right? So the news pundits are reading the report literally the day after I already read the report.
Right.
So like I'm already informed and I can see the schedule for all the years and, here's 2024 and it's like crushing, it's like over a whole percent in their, it really went up quite a lot in the progression. And so, as far as interest rates, would they pull it back? I could see them doing that a bit, but as you say, I would not bank on it.
Yeah.
That's almost you're getting lucky type of thing. The inflation is really crushing people. And the terrible thing about it is that I think inflation crushes like the lower class the most because you have gas prices going up. People can't even go to their jobs sometimes. It's too expensive. And so you have all this spending that was to save, people that had lost their jobs during the pandemic. And then here they are paying the price for it. And really people that, have the most capital are just going to be just fine type of thing. And so it's they really just funded too much money. They pumped too much money. I don't really see interest rates getting pulled back too much. Yeah.
So you're not playing that game or expecting it?
No. I try to just go with, in most things, I try to go with like Occam's razor approach, right? It's like whatever the simplest answer is what the answer is going to be, right? And we have tremendous amount of inflation. It's a big problem year over year or month over month. It's going down very marginally. I don't really see them pulling it. Really what they should have done is they should have raised rates last year. They could have done that because now it's really painful. And
this has been the fastest rate increase ever in history that
Yeah.
I mean, no one expected, and we all expected rates to go up, but not to get the brakes slammed quite so hard.
Yeah.
And we got a little whiplash from it.
Yeah.
Cool. Well, Michael, this has been a blast to talk about your move out here, the bigger picture strategy. I think as the market shifts, talking more about like the global perspective, because real estate is always, one investment options, not the best, not the worst. It's pros and cons. But I'm very much along your lines of thinking, hey, it's leverage, it's appreciation. And I go back to where else I'm going to place a lot of my cash. And I like real estate a lot for all the reasons we said. So I think as you progress and you figure out the fourplex, you get your waterfall strategy, whatever you do in place, I would love to have it come back on here in 3 months, 6 months, 9 months, whatever it is, as it shakes out in our inefficient market and the process, and then come back, get some reports from you, and keep tabs, because obviously, like, your mind tracks, it's very quick, and I mean, I would enjoy it, and I think you guys would as well.
Definitely.
Yeah. And we're going to, of course, include your contact details here in the show notes.
Sure.
But we always love to use this podcast as a forum for networking.
Okay.
So is there any people that you want to connect with or people reach out to? Always a great little place to give a shout out, or just some general networking you want to do to help you grind away.
Well, I suppose there's two things. Number one, I'm working on an automation platform for investing, right? So software runs backends in Python. Eventually, it's going to use machine learning and stuff. Basically, there's efficient frontier models for allocations, so it helps you allocate portfolios. There's different things that are a little tedious to implement manually, like CPPI, which is a consumer price protection insurance. It's a methodology to create ratios so that you never exceed a certain drawdown in the market, which is really good for people that are pre-retirement, like they're getting kind of close, but they still want that higher return, but they can't have like maybe more than a 5% drawdown.
Is that just maximizing like their safe withdrawal rate, basically?
What it does is say you have like 70% of your money in risk assets, and then you take 30%, you put in risk-free assets, and there's a certain multiplier, and it's almost based on how many times you rebalance per year. So say you do it 12 times a year, well, that's really good for automation. You have an email come out, it just tells you how to read, like the allocations is very convenient. So in doing that, you basically have a transition from the risk assets to the risk-free assets. Of course, the returns are less because of that, but your actual capping of the maximum volatility is pretty important for people that need to preserve their wealth, that are like kind of close to that retirement edge. So that's one thing. Then the thing that I'm excited most about is the options ranking feature. So there's a lot of data scraping and ranking of return on capital. And then there's it's almost like a proprietary system where you're using RSI and MACD and other indicators to create a success outcome. So give me the most amount of money, the highest return on capital, say in a week on a weekly option for selling puts as an example. But I want the most successful possibility chance, not just the highest return. And as an example for cash flow, because I'm big on that in a way, even though it's taxed a lot, there are advantages. Selling Tesla puts, at least pre-recession, was 1% to 2% return on capital a week. I tend to be big on the appreciation in real estate. So I don't know if we had touched upon that, but I remember talking before the podcast about that. It's wealthcompass.ai.
All right. That's a good domain.
Thanks. Yeah.
I like it. There's
a beta sign up. You can just put your email in there. I don't send out any spam or anything. The whole intention was really just, I want to build out automation software for myself, and why not just, allow other people to use it?
It's a good business model.
Thanks. Yeah.
I love it. So we'll put all those show notes and your contact details in there. So, I mean, people check out wealthcompass.ai, reach out to Michael, and we'll definitely, after this, we'll kind of talk about maybe a little rhythm to get you back on here as you kind of progress through the next series of your investments.
Sure.
So thank you, Jenny, Ben. Always love having you guys in the studios to talk shop. And anyone out there listening, if you guys have comments, leave it, comment on the YouTube video, reach out to us, talk investing strategy. This is what we love doing. We'll see you next week.